Hi everyone, welcome back to the Property Finance Podcast. And today I want to talk about 3 creative financing tricks. And I'm going to break them down one by one. We'll talk through each one very, very briefly, but just a really quick podcast about just 3 little creative tricks that I've been thinking of recently. I thought, you know what, do a quick podcast on these. So first one I want to talk about is vendor finance. So essentially this is where the vendor becomes the lender, which sounds a bit cheeky, but quite a few people operate in this way because actually it saves you quite a bit of money and it saves you obviously having to put a deposit in on some deals as well. So we've done a few vendor finance deals, worked with quite a few clients who've done vendor finance deals. And essentially what you're doing is you're going to the vendor and you're saying, right, based on a purchase price of X, I can obviously go to a lender, I can raise Y. That leaves me with a shortfall of Z. We then go to the vendor and say, look, would you consider putting in or leaving in Z? Obviously then becoming the lender on that element, that deposit, and taking either an interest or potentially a profit share or something like that towards the back end. So that's vendor finance kind of in a nutshell. The second one that we look at quite a bit with clients is option agreements. So that could be either an option agreement or it could be a lease option, slightly, despite the fact that both options are slightly different in the way they operate. So an option agreement is essentially the option to purchase a property for a set amount of money during a set time frame. So for example, you might say to a landowner, I want to purchase this property for £100,000, £200,000, whatever the figure may be, at any point over the next 5 years. And you'll go to them and you'll give that option. You'll say, if you agree to that, locks them out to being able to sell it to anybody else. And essentially you then have control of that property. What would happen is during that option period, you would go and get planning permission. You might decide to do something, some works to the property or something like that, whatever you've agreed within the option agreement. And during that option period, what you're trying to achieve is essentially getting the value of that property increased. So if you go and get planning permission, for example, you have an uplift. Some people call it planning gain, some people call it planning uplift, but essentially you've increased the residual value of that land. So what happens is the residual value is what a developer can afford to pay for a plot of land. And the way that it's worked out is essentially they work out the GDV, less 20% developer's profit, less build cost, less interest, leaves what someone could afford to pay for that land. And that becomes the residual value. And what happens is you then raise finance against that residual value. So for round numbers, you might go and do an option agreement on a plot of land for £100,000. You may then go and get planning permission for 4, 5, 6 dwellings, however many. And then the residual value of that land becomes £200,000, for example. And then what happens is you go and get a bridging loan or development finance against the value of £200,000 as opposed to the purchase price, that option agreed price of £100,000. And because you've created that value within that property, so by going and getting the planning permission, you've created that value, lenders will look at it as something called sweat equity. That's what they call it. And essentially that means that you've put in the hard work, e.g. the sweat, in order to create that value. And they see that as your input into that deal. So rather than having to find cool hard cash to put into that deal, you obviously use that sweat equity as an input instead. And then the last one I want to cover off briefly is delayed completions. So we've had this with a couple of HMOs recently where clients have agreed to purchase a property, they've exchanged with a delayed completion of 6 months. I think we had one that was 9 months, we've had one that's 3 months. And what happens is during that period of time, you go off and you go and get the works done. So if it's converting a property into a 6-bed HMO, 7-bed HMO, or it might be converting an office into flats, for example. So if you've got that cash there to do the works, but maybe you don't want to go and spend out on bridging finance, for example, then what would happen is you would put that money into doing the works instead. And again, very similar premise to what we've kind of spoken about previously, which is you exchange at one price and then you actually complete with that property being worth hopefully significantly more. So for example, on a 6-bed HMO, you might exchange at 150, go and spend 25 grand, and then it might be worth 200,000, for example. And then what would happen is based on those numbers is you would then be able to go and raise a bridging loan or a buy-to-let mortgage against that £200,000 that it's then worth after you've done the works, and essentially then cover that full 150 purchase price. Obviously, you put 25 grand in at that point. Hopefully, you'd knock the value up slightly higher, but the 25 that you've put in is purely money that you've put in to increase the value, as opposed to if you went and got a bridging loan at 150,000, for example, and had that bridging loan in place while you were doing the works, you've got to pay the 25 grand for the works, and then you've got to pay the 15, 20 grand's worth of fees, interest, and everything else. So sometimes it can be just a nice way, if you've got a smaller pot of money and maybe you haven't got enough money to cover the deposit and the works, that could be a nice way of covering it. And what I'll do is, if people have found this episode interesting, is what I would say is drop me a message, let me know, and I'm more than happy to kind of send you some worked examples of how this can work. And if you want to talk through some deals and how it could work for you moving forward, more than happy to run through those deals with you. And like I've always said, if you found this interesting, please do leave a review. Let us know that you've enjoyed the episode. And yeah, if anyone's got any questions, reach out. Otherwise, I'll catch you on the next one.